Hello guys, welcome back to a new video. Today we're going to be talking about market on close model, aka the Moc model. This will be a very easy model, will be very consistent, and can see this present at least 2 times per week. It will be boring as it will be very easy and repetitive, but this will really pay the bills if you stick to it and apply it to the letter. So let's start to the explanation. What is Moc? Moc is referred to market on close, meaning it's referring for the last hour on the market when we cut out from 15:00 to 16:00. So 1 hour gap it will be talking about. Our time window for Moc, we will start to hunt for our Moc setup from 15:30 to 15:15. We will dive more on the times as this will be a key element for our trading model. With the key times, we want to frame it our entry and our exits. So how can we anticipate the Moc? Moc will deliver price to some sort of liquidity when it hasn't reached to it yet. Meaning it hasn't finished its business with the drawn liquidity. If it has already to take out the drawn liquidity, price action might just consolidate or reverse. Also, the times you are not going to see this work is when we already haven't moved a lot on the day, in the middle part, or on the overall day, or in the middle part of the day, or right after lunch when it did what it had to do, aka running for some sort of liquidity. When this happens, we can see some sort of choppiness on the last hour of the Moc, where we are going to try to approach and seek for our setup. When we will not work, the times you are not going to see this work is when the day, already explained this. So how we approach to it. We approach to the market for the Moc model from 1550 to 1545, as this will be our last hour macro. This is the only exception where the macro changed from the traditional XX, just like this one. Let me explain it easier to be clear. When the market changed from this traditional macro setting, we will be using the 15 to 45. Only it will be applied to this. So the last hour macro will be from 1515 to 1545. The market will engage to liquidity that hasn't been taken, meaning it will want to pull some sort of liquidity after it. We want to see smooth edges, clean stops, either buy stop or sell stop, but they must be clean. We want to see also some sort of range. We have these times. We will need to have these times on our mind, as this will be the key parts of the model. From 1557 to 1600, aka 3 minutes only left. This 3 minutes interval, we can potentially see the market make a retracement. So we already must be out on this part of the last hour of trading. From 1550 to 1600, the market will stop spooling price, meaning price will stop moving for our drawn liquidity. Spooling is when the price begins to run in one direction, either upwards or downwards, targeting some sort of liquidity or inefficiency in the market. So after this time is passed out, we will see more slow price most of the times. So from the moment, this is spelled wrong, sorry. For the moment here. From the moment of our entry to 1557, we want to see price action to keep pushing to our end goal. 1557, as we already said, that we want to, we will see a potential retracement. We want to be on a position earlier from these times. So let's jump to a scheme of the model. This is what we will be seeing some sort of on the market. Um, and the way we are going to approach this is we want to mark out the 1500 opening price to know how can we use this as an implied dealing range, just as the midnight open. We want to be buying or selling below, and if the closer we are to it and for it to catch the manipulation, it will be better. We are going to see some sort of low probability mocks and how you unreal trades examples that I took along the last 2 weeks. So this is what you want to be seeking of. Have some sort of SMT on the highs or the lows, depending how your drawn liquidity is set. If this is paired up with some sort of higher time frame key level, our higher time frame key levels for this scenario will be using from 15 minutes to 5 minutes, and we're going to be trading 1 minute. That's how I've been using it. Also with the SMT and the hard time frame key level and the range. So if we see a range on the 5 minutes, it will be a good mock. Rather, if we just see a 1 minute range, we want to see some sort of purge on the highs. Once we tap on the hard time frame key level, meaning we will have some sort of turtle soup, but this is more a band, so you don't really need to get in the turtle soup. And we must have this on mind to have something obvious to market, to target, for us to enter on a position. If we do, we can enter. If we don't have any, we avoid the market. We can see some sort of obvious range or obvious model, just as like the market maker models. You can see it fractalized on a smaller schematic. From 1530 and above, we want to start to hunt for our setup. We can already start to engage with price a bit before it's also flexible to it, but I would rather to stay to enter on a position after 1530. Also, we need to have some sort of SMT on higher time frame key level and the obvious range. So this is most likely what you're going to be seeking of. And by this time, as I said, from 1550 to 16, we want to be on a position already by this time. So our position must be from 1530 from around 1545 or 1550. By the end of this, we want to already be on a partial or break even or already be out of the trade. Moc model will be a very explosive model, very quick and entry and exit, so you must be really sharp on it. I like to always take partials on the low hanging fruit. The most obvious partials will really save you up your wallet, save your risk management. You will see better results with it. Stay consistent on it. So now you know what we are going to search off and the basics of the Moc model. And as you see, it's a very simple model, straightforward. You just need a range, a hard time frame key level above or below, an SMT, finished business on the drawn liquidity. And if the price action already moved a lot, you stay out. If it hasn't, you can approach the market. So let's jump on some real examples, some trades I actually took. And there's evidence on the Discord, and as well we're going to see the executions. So let's jump on to the first one. The Moc model is a really simple, straightforward model. You will see it very easy most of the times. If it's not easy, we don't want to approach it. That's as simple as it gets. So I want you to see this picture on price real quick. From here to here. I will give you a couple of seconds what you can see from between the two assets from ES and NQ based on what we've been talking about, and you will see and you will be able to see our Moc model. I hope you already put on pause the video. So you see it's very messy, sorry, but I will talk about on it. Give me a second. So if your eyes went from the SMT with this high, you were right. We already have our SMT. We have this SMT, so we have our first condition set. We have our higher time frame key level, which is this uh, box, which is a higher time frame, a 15-minute fair value gap. So we have already our two things aligned. We also have this sort of range, so we can target at these clean sell stops. So let's zoom a bit more on it. You can see it cleaner and we can explain it better. So the first thing we want to do is mark out the 1500 opening. So we have here the 1500. Here we can see how we start to chop out, chop, chop, chop. Then we break right on our times. As you can see, from 1515 to 1545, as we explained, here we just can see how market target the stops, meaning we can already take a trade. If we position here, we want to be in a position by 1515, which we already in, or if you just take the rejection block and from 1557, as you can see here, where it's most likely for the price to stop making the movement, we can see it crystal clear that once we reach the time, market was slower and start to go against us a bit. I actually took partials here on the low hanging fruit and on this other low. The end results, we didn't take the sell stops due to an SMT with YM. As you can see here, pop this up real quick. As you can see here, YM did take the low rather than ES or NQ that didn't. So we have an SMT right there to end the move, so I just close it out. As you can see, it's very easy, very straightforward. You just want to see some sort of range SMT, hard time frame kill level. We can see here the stops, the total soup, as I explained. Then we have the rejection block, entry, or you can just enter here on the total soup if you want, but it's more advanced. And you can just really see how straightforward it's the model. So let me pop up real quick an example, the execution I did take. And as you can see, it's just as explained on the previous slides on the schematic. It's just real simple, straightforward model. So here we can see how I took the entry right on this candle. Just have conviction on the market. I wasn't scared of this movement up. So I knew the market was going to deliver. Then just took a partial right on this low hanging fruit, as I explained, and ended up closing the trade about something about here, taking a partial here when I start to see some weakness on the market, and just closing up on leaving the market with 20 something points 15 handles on ES, if I'm not wrong. So you can see it's very straightforward example and model, very simple. If you really don't have success with this model, of you are lost on searching your model, this can be easily your model. You will see it very easy, very explosive, very fast. Let's go through the next example. Let me fix this real quick and go faster here. So once again, what you can see on this will be an example of a low probability Moc model, where you can still make cash on it, as you will be seeing. As you can see, there's nothing too crystal clear on this 5 minutes, unless this sell stops. And if I'm not wrong, I think it was some sort of SMT. I might be wrong. Let me search up real quick. Yeah, we have some sort of SMT here with NQ. So this is our only condition, and our hard time frame stops. Some sort of liquidity getting run out. Then we zoom in now 1 minute for the explanation. We will be able to see it more clear. You can see here, we marked up again the 1500 open. And as you can see, we're very away from the opening. So this is making a lower probability. Yet we can still see some clean stops right here. A way we can target the liquidity. So once we start to run, I just wait 1530. Remember, we want to start seeking for a trade from 1530 onwards. And our last time to get an entry would be 1545. 1515, sorry. So this is how our times we will be using. We have 1530 onwards, we seek our entry. 1545, we want to be already in a position preferred, as market will stop most of the times to pull price, or already be taking out some sort of liquidity. So you'll already be able to take some partials. 1515 is where the price will most likely already stop delivering. So you will be able to see a lower price. You can still be on a position. If you position yourself well by 1530, or from this window from 1530 to 1545, you're on the trade is already delivering quite a lot, but still hasn't reached your drawn liquidity. You can still hold your position to see how 1550 to from 5050 to 6000, how it's going to deliver. You not necessarily see as 1550 gets on time, you close your trade, as you may be missing out some sort of opportunity or some sort of full TP. So just be calm. If you already position yourself well, don't worry, just trail your stop loss for a safe position and logic placement, and you will be good. If you already took a partials never fail, so you're already on a profit for the day. So here we can see another way to approach the Moc with an inverse fair value gap. I took my entry right on here on this candle. Then I add another contract on this dipped on the bearish candle, as I wanted to support and pull price higher, and I had conviction on it. I took one partial right here, or multiple partials. You can see how fair value gaps are supporting the price. When you see that market it's really moving straight forward without making any retracement on a fair value gap or any balance, this will mean you are on a very heavy trended market that is only one side direction. This will be a very fast and explosive delivery. So the less retracement for a fair value gap, the better the setup will be, as it's not showing any some sort of resistance on going to the other way, not even making a retracement. Market just wants to deliver the price. So here I'm also have got some example I did get, and for the people that are on the Discord, you already know the drill on the Moc model. The last couple of days will be very crazy. So here you can see I took my positions here on the inverse fair value gap. I took a hella positions because I had want to add more positions, but I only had the one contract, so that's why. Then I add another one right here. Took a partial right here, so I was already on a safe position. You know, partials never fail. You never lose on a partial, so why not if you're already on a good placement, just to save up. And I think if I don't remember wrong, some asset made an SMT right here, so I saved up my wallet, then took two partials right here on the buy, on once we talked the buy stops, then win a fulcrum placement on the 1 minute, on the 3 minutes, I think so, on the less one standard deviation. As we explained on the Q&A with Danny, the fulcrum placement. So that was just right there a partial, then ended up taking the last two contracts on a stop, as I trailed my stop loss right here. As if we are really going to push the market higher, this intermediate term low, which is some low that retraced on a fair value gap, we don't want to see this get disrespected. So it end up staying on a partials but not full TP. As you can see, even if it's a low probability mock, when we don't have all the sort of conditions we would like to see, we can still see the model present itself very well, and you can still get some sort of big profits. Very consistent, you can see with trade, and you can see how the times I talked about their work just as explained. Here we can see from 15:15 to 15:45. This is our macro, last hour macro. Let me blend this up better. Last hour macro. This is, remember, this is the only exception where price won't be on the classic schematic of 15xx15 to xx10. This will be the only scenario when this won't be applied. Then we see 1515 to 1600. We see that market stopped delivering higher prices as it should, as the program is already activated. Remember that a buy program or a sell program is not the same as a market maker buy or sell model. There's different things. A buy program is when the market is on a rush, it's on a delivery or higher prices, and a sell program is when the opposite, when the market is on a rush, on a delivery of lower prices. So here is on a buy program delivering to a higher prices. Then we can see that the 1557 to 1600, sorry, bunch of time, and I get confused sometimes. Remember, English is not my main language, so just keep patient with me. Here we can see that market stop and to make a retracement against this previous movement. So that's why these times I present to you are key. And if you really stick to it, you will see great results, trust me. So let's go on the next example, which will be on a Friday. I think this was clean. Yeah, this one still, I think, got stopped, or I don't know. Yeah, I ended up closing you some sort of for the reason explained, but I want you to look even on this 1 minute chart. Remember, it's all fractal. What do you see from this from this picture? You can spot the Moc model. Think about it, analyze it. Remember the scheme I presented to you. What do you see? Let's jump to a 5 minutes for you to have the higher time frame if you want. What do you see? What do you see on the 5 minutes? Cleaner. It's shouting you to take the trade. Well, as you can see, as you can see, uh, here we have our range. We have some sort of sell stop and buy stops. We have an SMT with NQ. This is wrong. This is an SMT with NQ. Sorry. SMT with NQ, because NQ didn't take the high that ES did. We then forward, we have another SMT once again with NQ. Then we can see on a 15 minute. Remember our time frames that we are going to be applying on. It will be 15 minutes, 5 minutes, and 1 minute. You can also implement the 3 minutes if you want. 5 minutes and 15 minutes to identify some sort of range or higher time frame key level. Remember that 1 minute can fake you out with some fake ranges where you can get chopped into. So here we can see where even if we are not seeing a strong reaction of this CB, and we trade on the upper quadrant of it, we can still use this and present it on them for the prices. It's not the best scenario for a hard time frame key level, but in the 5 minutes we can see this for other CB right here, which this one really pulled the price to our direction. So we have our SMT, our higher time frame key level, we have our range, meaning we have buy stops and sell stops above and below. We drop to a 1 minute. We mark up the 1500. That's the first thing we want to see on the day. Then once we push to one side of the stops, and we have our obvious stops to target on. Once one of the side of the range gets target on, we want to position ourselves above, preferably above this buy stops or sell stops, as this will be our order pairing or smart money reversal, whatever. This is where the manipulation will be made of. So in these areas where we want to be positioning ourselves above, or the closer the better. So once again, we have our stops, then we have our total sup above the buy stops. Notice this. Notice how on the previous examples, our total sup doesn't occur right here. Most of the times, it occurs above. So it takes two pulls of liquidity, a higher time frame than a lower time frame. I give you a hint right there for you to see the total subs better and more precise. Then after the total sub is created, we have our order block. We have our order block right here, right to the tick, zero drawdown right here. We use the body of the candle. You can see it's this price level. Then if we go on the wick of the candle of the order block that rotates on the order block, you can see right to the tick. You can also take a position in the wick if you want, which is the one I took. I will show you the example. Here we have a fair value gap that we don't want to see it get traded on, meaning we can place our sell stops. I don't know if it says the right. Our stop loss, sorry. We can place our stop loss right here on the breakaway gap or our back with the mohawk, whatever. Why this one is a fair value gap, we don't want to see it get traded on. Because if you see the Danny and Q&A, my Q&A with Danny of the past week, we pull up the 50% from the end goal to the start of the movement, and you pull up the 50% of it once you see a fair value gap that cut through it on of the 50% of the range. This will be a measuring gap, or that will be working as well as a breakaway gap. In this case, I think the measuring gap doesn't work quite well unless you took a partial right here. That's also good. Then we have our low hanging fruit right here. So remember, taking partials on this model will be very, very, very good. Will save you up a bunch of times and you will see more consistent results. Yeah, you will cut up some profits, but you won't lose. You are taking and saving that money already on your bank account. Or this is the low hanging fruit, as this is the end of the like a smaller range. You can see like this one. Sorry for the messy charts, just a bunch of things. So that's the end of of this price movement. So that's our long hanging fruit. You can still take partials here, but it shouldn't reverse right here because it should cut like butter. In here, we have more probabilities to take up on us. So here I'm going to show you once again that this is not a hindsight example. This is an example I took also, I think I told the guy on the Discord we might have a mock this day. You can see how I took my entry right here on the week of the order block. Once I saw it tapped in, I add my positions. I had convictions. I had conviction on the market. I knew it was going to happen. Then took a partial right here just to save up some profits, but this was a bad partials in my opinion. Yes, like a soon partial. Then took another partial right here on the long hanging fruit. Then another one right here on this low, because I had so many contracts still left, so I would rather save up my position to really save my profits of the moment than rather losing it. Plus, once I took this partial, I saw that NQ made the SMT and we started to see some sort of weakness, so I just closed out the trade and let it go. You can see how here we applied the same price, the same time premise as we were talking about. 15 to 15:45, our last hour macro. Here, last hour macro. Remember, this macro will work to take out or deliver to some sort of liquidity. In this case, we took out these buy stops. We took out that liquidity level. Then from 15:30, we want to chase and hunt for our setup. So we have this 15-minute time window for us to search for a trade. You can see our trade, it's inside of this. And further on time, we can see the sell stops really get tagged on, but all the people that took this, they already cooked. And why do you don't take this position rather than this one? Because if you look at time, if you pay attention on what I've been talking about, by this time you all need to be on a position already. If you take a position on this last 10 minutes, you are reducing your chances to get a successful trade. Because remember, from 15:15 to 60:00, the market will stop pulling, aka the market will stop running in one direction, either bullish or bearish, for it to target some sort of liquidity or inefficiency, whatever. So by this time, you already need to be on a position and prefer to be already on break even. You can see it's very, very simple. Mostly they are textbook scenarios. So let's jump on to the next one. It's this one. This case will be on Monday. We can see this very, very beautiful mock. You can see how explosive this is. Maybe this one wasn't aligned with our times as we prefer to, but you can still see how it delivered quite nice, as you can see here. So let me check something real quick. I don't know if I took this one. I think I didn't take this one. Let me check on Q. This is the one I took. Yeah, no. Even if it delivered, and it was kind of clean. You have the SMT with YM on the lows, pushing price higher. We can see we have our stops, some sort of range. Totals, here's sell stops. Then here we got the total soup. You can see how still it presents well. Remember, we want to be taking a position the closer or inside the order pairing below the sell stops, below this red line for in this example. Here you can see how price explosive fast delivery once we tapped on this BC. So in this case, we didn't respect these times that we were talking about. So let's just not dip too much on this example, but I will give you some other stuff. As you can see, if you remember, and if you have seen my previous video on Power of 3, as you have seen and analyzed the previous examples on the 1500 open, close or before it, most of the times we will have our range that we will want to be playing off of. So let's jump off to the next example real quick, because this is not as good example as I want to show you. On this one was clean. I took this one. So you can see right here, let's go on a 5 minutes. I think it wasn't another example right here. Hold up. Let me see real quick. Yeah, this is the only example of from this week, I think. Well, you can see here on the 5 minutes, we have a PC up right here. We want to see this get respected through. Then we have bearish candles on a bullish market. I want this to support price, and I use this the wick of it as it's nested with the fair value gap. You can see how price dip into it and start rejecting from it. Here we can see also that we have a 5 minute range. You can see very so clear. It's explained and shown on the previous examples. So far you can see how textbook, easy, straightforward model you have here. Like, this is really simple model. For you just to stay on the markets a bit, 15-30 minutes of your time, and just destroy the markets with this thing I'm showing you. So you can just destroy and pay the bills with this. Here we have some buy stops, some relative equal highs here. We have our range, our low hanging fruit. We have our sell stops, our order pairing. We want to be placing our position below this. Here, once again, we can see the total soup in play of this model. Then we have an order block. We have an order block that we react from, which is this one right here. And the low hanging fruit of the range, inside the range, not the external of the range, as this would be the buy stops. So as I said, remember to take partials with this model, and I will show you that this wasn't another hindsight example. So you can see how every example I'm showing you, I really did take this, not just talking about it on hindsight and not knowing how to apply this on live market. You can see here, even if it's on the MNQ and we're on ES, the same. Here you can see I took my position on NQ right on this dip. Why on this dip? Because it had a potential, by the price signature, we can have a potential signature of an immediate rebalance. Due to the total soup and due to other factors, we can anticipate and wait and time and try to time it correctly, as well as this one, as this entry I had right here, the second entry. Then I took a partial. I don't remember why I took a partial right here, to be honest. I think let me check why I took a partial right here. Let me open MNQ. Well, it's not, doesn't matter. Like, let's just focus on this. On the example, once again, you can also take a partial on the 50% of the range that we are making. You can also save and gain some consistent results with it by that. So we have our order block, our 50% of the range, whatever. We have our low hanging fruit. So if you position yourself here or here, stop loss on turtle soup here or here, I would place it right here. Look, partial on the low hanging fruit with ES 2.3R risk to reward already. And if you hold your trade to the stops of the range, almost 4 risk to reward. But I shouldn't, or I don't trust on holding your trades more on this scenario, because even if it played out and delivered as explosive as you can see right here, once again, we must be strict with our rules on time. 15:30, we want to see a price to hunt our setup. We want to hunt our setup on this 15 minutes time window. You can see once again it's inside it. Then 15:15 stop, it's pulling price higher, and 15:57 to 60.00 we make the retracement. We make the reversal, the retracement of this previous movement, which makes it like a fake flag or something of retail. I don't know how it's called. So we can anticipate also a turtle soup, another block. Boom. Explosive, explosive, fast, deliver. That's how the Moc model, it's fast, quick, easy. So you can see it's very straightforward, not too complicated, easy, repetitive, easy to apply. You just need to eyeball it most of the times, repeat, backtest, adapt to it, and you will see how consistent the model is. And trust me, if you stick to this, you will be able to pay some bills with this. Very, very simple. Trust me, I've been seeing it and applying it recently. And that's all for today's video. If you like it, give me some feedback on it, of what video you want to see next of some sort of models, and I will see if I can do something about it. So see you guys next time. If you if you have any questions about the model, or you want to share your results or something, tag me in the Discord. Will be on the description below. So be safe.